All right. So, hello everyone again. Nice to see everyone in here. This is Chris Haven with Personify or Dr. Steer. Or you now I'm gonna go with Dr. Stock. That's what my new nickname I'm thinking is gonna be, not the professor anymore. But we'll see what happens with that. So today, uh, this was made when the market was nearing the correction territory. So that's why I kind of made this class because Sunday was already scheduled um, for futures and whatnot. Let me close my door. I forgot to no interruptions. But uh, but so this is kind of what you can do to protect yourself if the market's falling. There are some more advanced strategies that are involved in this class, or just yeah, this class. But yeah, so let's dive in. This will be a little bit shorter. I'm trying to get more podcasty and um, in the works for all that stuff. But yeah, so let's talk about hedging and asset protections, which involves puts. There's some other things too, and I'll go over them. So the first thing is, are you in a good stock position? So I've talked about this before in previous classes. It's like, what's the percentage of your portfolio? And I always say, if you're into like deep into one stock, like all in GameStop, for example. But obviously we don't want to go all in on GameStop unless some of you did today, which whew, interesting. I always say try and keep 20% into at most one stock. And when I say one stock, I mean including options. Oops. And I need to get a stylus. I'm sorry. I'll just type it. Just make it easier. 20% in one position. Or I'm sorry, in one company. So that is including stocks and options, or warrants if you even want to talk about those. But so for an example, because if you put all, it's kind of like going back to your thing. Like if all of your eggs are in one basket and that basket drops, well, let's hope you're pretty good at picking up those eggs and those eggshells and putting them all back together, because it's not going to work out too well. Good example is GE. A lot of people put all their money into GE, and even today, they went down a little bit, but because they're talking about a reverse stock split as well. But then again, that has there's more things to it. But putting all your eggs into one basket, it's not good. We talk about diversification. I really like to diversify a lot with mutual funds, and that's what's going to come up next week. But yeah, so that's just the one thing that I really want to emphasize is just, are you in a good stock position? How about the amount of shares? If it's a lot and if it's over 20%, then you may have some issues if the market goes down and you have to liquidate. So that's one of those big things that I like to emphasize. The second part is, the market's down. Should I buy puts? So I haven't really covered puts yet. It's basically it's an inverse call position. So it's the right to sell, not buy. Just for the people that are in here, do all of you understand what a call is and what a put is? Because I can go into more detail on that. And I just want to make sure we got the foundation first before I say what a strategy should be with puts. Why should you buy a put, and what time frame should you look at? Okay, so some of the people are saying not really. So the next question would be, do you know what a call option is? Okay, so in that case, this part will not make as much sense to you. That's fine. Uh, but uh, if you go to my previous classes, you'll see what an option is. But what I'm going to do just real quick, regarding with if the market's down, if you have a stock that is more susceptible to the broader market, such as the S&P 500 or the Nasdaq. So if you have a tech company that you think is pretty much in tune with the Nasdaq, uh, then the strategy is usually you want to give it a couple weeks to a month and puts are kind of like insurance. So kind of like, with insurance, oops, that's a little too big. So puts kind of like insurance. And so what does that technically mean is it's the right to sell at a certain price. So if the stock goes down, then you have that put contract or that insurance, and you can then basically make the money off of having the stock, but still selling it at the same position, and then you can either take that money and buy more into the position, or you can sell that contract option and you can do whatever you want with it. It doesn't matter. When I talk about doing options, it's getting a little bit riskier now in the market. But again, if you own the equity, so if you own 100 shares of, I'll just put an example, and I'm going to draw up this one. So let's just say I own, I don't know, let's just say Tesla. Okay, and I have 100 shares. And I know the market's going down. I would buy one put at the money. So remember, ATM is at the money, not where you get all the money. And I would set it for 1 month out. Now, what can this do? This can give you protection on the asset. It can protect it. It can protect it against earnings. It can do a lot of stuff. Now, those puts can be expensive. Like, because I did Tesla because it's tanking, so I was just thinking about it. But I know it went up, but now. But anyways, just when you're dealing with that, I would say a good strategy would be at the money if you think that your stock's going to go down. Now, if not, that's fine, because if the stock goes up, your put is only going to be a couple dollars of the premium, so it's not gonna make the difference. And then Aaron asks, what does at the money stand for? So at the money means you would buy it at whatever the stock price is trading at. If you're not into options right now, then I wouldn't worry about that stuff. I would just worry about if we're going to short or if we're going to go long on an asset or on a position. So this second little part, this is if you know how to use options and you know how puts and calls work. I mean, you can sell covered calls, yes, but I call puts you can do protective puts. That's what they kind of call them in the finance world. But this is just, again, I'm not saying to do this like every month, because you'll waste a lot of money in that. Unless the stock keeps going down, then yeah, I mean, keep doing it. But this is more like if there's some really bad news coming out and you're kind of nervous, and if you have some extra liquid, or if you have some money and you want to just protect yourself, think of puts kind of like insurance, which is, again, puts are the right to sell at a certain price. Now, you can take that and sell it maybe like a week later, and then make money, and then the stock goes back up. That's totally fine. That's what some people do. Again, but options are a little bit more dangerous if you're doing them what's called naked, so not having the position or not having the equity in that. The next thing, if the market is going down, is should I short? Now, going long is one way, but then going short is another. That's why the markets go up and down. It's not just you put in money and then you sell it. There are other people that can say, hey, I want you to buy this at a certain price, and then I'll buy it at a lower price, and then they keep the money. So when we deal with shorts, and I'm not going to go into how the shorts, how they work, I'm just giving you, again, tools for your toolbox on what you should be doing. And I mean, I've covered I've covered calls and going long. I'm kind of just slowly giving you the idea of, should I short something? Now, can you short something on Robinhood? That I don't know. I don't think you can. I don't use Robinhood. I know Webull you can, but you need $2,000. But basically, shorting is just going the opposite way of the stock. So going, so should I short? So if you think the stock is going to go down, you can short it instead of going long. Oops. So what I mean by that is selling instead of buying. Now, this is good for a short term because you get what's called, you have interest with shorts. And again, you should research this a little bit more before you get into it, but I'm just kind of talking about it just so you can get an idea. Webull does have the shorting feature. So a good example would be GameStop today. So GameStop went up to $348, then it fell down. So instead of saying, okay, well, if the market's going down and I want to protect my assets or I want to increase my assets, you could short it instead. Now, there is some caution with shorting. So caution with shorting. You are charged interest per day per amount of stock with an interest rate. So what are the interest rates of the stock? That determines, that's up to the broker. I did pull up for Webull what the interest rates would be if you decide to short. Again, I'm not telling you how to short. I'm just giving you ideas on what you could do. So an example, short interest. Let me pull up the rate real quick. Sorry about that. So while I'm pulling this up, are there any questions on just kind of knowing if you're in a good position? You know, do you have the amount of shares? Is the percentage of portfolio? The puts part, you know, that's a little bit more advanced for some people. But then also it's going to short. And for whatever reason, I can't find the interest rate. I had it popped up and I don't know where it went. So I have all these screens up. I'm trying to find it, and I'm trying to find my mouse. Sorry about that. Well, for whatever reason, it's not. There's that. There's that. So it's roughly 7%, and that's APR. So it's, you know, if you weren't to calculate the daily interest, it would be, you know, it's 7% divided by 365 days, and then you multiply that by the amount that you shorted. But again, shorting this is a newer thing that I'm showing to people because, you know, obviously if the stock market's going down, 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 just flip it around. Ooh, I like that. Just flip it around, okay? And that's when you just change going from long to short. But with short, there are some more charges involved with that. But yeah, so if we do get into more correctional territory, I'm going to go further in, more deeper onto what we can do with that. Okay. So if anyone has any questions, just you're more than welcome to speak up. But we'll move on to the next one. So another way to protect yourself is what's called hedging. Hedging is when you use, there's multiple ways to hedge, but one of the better ways to do it is you use a different broker for that. So kind of going back into the shorting, you can't be long and short. Think of it like positive and negative. They cancel each other out. So if you have a negative one and a positive one, it would be zero. This is more of an advanced option again with shorting. So if, let's say you have a main account and you're big into Palantir. So let's take a look what Palantir is right today. I don't even know what it was. I think it did pretty well. So for the day, Palantir went down. Well, a little, not really. It didn't do much. So Palantir's been just kind of floating. So let's look at GE instead. That's better. So let's say you have an account and you have 100 shares of GE. And I'll write this. So let's just say you have 100 shares of GE. So 100 GE, and you heard this news, but you still want to hold that stock. Okay, but I want to short it. So how do I do that? Well, if you have a different account, what you could do is, and as long as there's enough money in there too short to cover the margin, or the loan, what you could do is you could hold it on one account. So one account is plus 100 shares. That means you own 100 shares. I'm bad at writing. Then you have the other account that's minus 100 shares. So that's what hedging is kind of like, is you have, in one hand, you have the stock position of 100 shares, but then you have another account that you short it. So kind of, I talked about shorting. And so that's kind of how hedging works, is because it's kind of like a magician, where they make you focus on one hand, but then you're doing other stuff with the other hand. That's what hedging is kind of like, because in one hand, you're still holding on to it. You're hoping GE makes a rebound, but you don't want to sell it because you maybe you don't want the watch sale rules. Other reasons you want to hold on to it, get the dividend, things like that, which is 1 cent, but just for whatever reason. But if you want to still make money off of it, you can then hedge it with another account, and you can short it. So that would mean you're selling 100 shares. So if I shorted, and just an example, if I shorted at $14.20, and let's just say I held it for the day, because it looked like GE was kind of flattening out right here, and then I cover my position, I made $1.08 times however many you got, and I got $1.08 because this was 13. It closed at 13.12 at the end of the day. That's where I got that. So again, I'm not telling you this is what you should do, but again, it's just more tools at your disposal. Anyone can make another brokerage account. If you have Schwab and you want to make one with TD Ameritrade, you're more than welcome to do so. Can you open up more than one account with one brokerage firm? You can, but if they're in different categories, but I don't think you can separate the brokerage accounts. That I'm not sure on. It's been a while since I've looked at that. I've always just done different brokers for those things. But yeah, so looking at that, that's kind of how we do hedging in that respect. So if there are any questions, you are more than welcome to unmute and ask. I know that some of this may go over your head a little bit, but then the more that I start showing you different strategies, this may come back to like, okay, this makes a lot more sense. Why didn't I show this before? Because the market was going down. People were asking, what should I do? This is what I'm giving you. So that's that. Okay, so let's say you don't want to short, and that's totally fine. If you don't want to short, because if you think about it, if you're going short, you want it to go down. Well, it can only go down to 0. If you want something to go up, well, I mean, the sky's the limit. Or I'm sorry, not even the sky, the galaxy is the limit, or whatever planetary or celestial object you want to state. So these are what are called inverse stocks. So there's not an inverse stock for like Tesla or for Amazon, but just in the market in general. So basically on the indexes, like SPY, like QQQ, Dow Jones. So SPY is S&P 500, Nasdaq. The Nasdaq comp. Dow Jones, just Dow Jones. We also have mid cap and Russell 2000. So I won't explain what those are, but these are what you're looking at. So the main one I want to look at is SQQQ, SDOW, and SPXU. Now, these are what are called inverse ETFs or inverse stocks. And what these guys do is they are in a fund that shorts stocks. That's what they do. But you can go long on what they're doing. And so it's kind of like a mutual fund or an ETF. Whatever the performance of the market does at that time, that's the return you're going to get. So The one thing that, and I don't, or I will not recommend it, but I want you to do more, more research into it, is these are what are called leveraged. So if you're, and what leveraged means is that's what the 3x and the 2x and the 1x means. That just means for every point that the whatever the index does. So let's just say SPY is at $1. Oh no, sorry, $3. And you have this SPXU, and you bought it for $1. So the 3x means for every $1 the SPY goes down, this is going to go up 3 times. So it's kind of basic math. If you have the 2x leverage or the 1x leverage, 1x just means it kind of moves in tandem with it. So if SPY jumps up to, now again, I chose a bad number. Let's just say it's 30 instead. So if this drops down to 29, this now is, and you bought it for 10, this is now $13. It's not multiplied, it's just for every dollar, it's $3. Just put it like that. Or for every point, it's 3 points. But now this is where leveraged you can get in trouble, because if you get in for $10 and then SPY goes up $3, you're now down, more money. Now, how it's calculated, it's not exactly like that, but just layman's terms, that's what it's like. That's what it's at. So if you don't feel comfortable on doing leverage, and again, leverage is for more advanced or for more advanced traders, but if you have a feeling it's going to drop down, then why not get into it? Okay. But if you want to just, if you don't have the certainty, if you think, oh, it's going to go down a little bit, but I'm not quite sure. The job reports are good, inflation's not looking as bad as I thought, it's just we're having a bad day, then just do the 1x or the 1 point for 1 point. So I also put the other ones here, the 2x and 3x, not the negative. That's if you think the market's going upwards, and you want to get more return quicker, then you go into that. Some caution again with leveraging is it's a multiplier. So for every dollar or point one thing goes up, it's going to affect the leveraged account by 3 times or whatever the X is. Don't go into anything over that. There are leveraged products out there that are like 10x, like gold. I think the highest one's like 10. So if you put like 10,000 in, gold goes up, or I'm sorry, yeah, and gold goes up, then yeah, you make a lot of money. But if gold goes down, oh, you're SOL, or gold out of luck, you're GOL. So yeah, so that's kind of how the inverse stocks work. Again, leveraging is not for everyone. You don't have to do it. Also, just keep in mind that these are for shorter term plays. So maybe for like a week, even if that, these are not really meant to hold for a long, long time. If you want to, that's fine. But again, if you just remember, statistically or historically, the stock market always goes up. These are just ways to hedge and then to protect assets in a short period of time. So like, for example, if you heard about the coronavirus last year in February or in March even, and you're like, ooh, I'm not feeling safe, but I don't want to sell anything yet, but I want to capitalize on this, then looking at these inverse stocks or these inverse ETFs, these can give you some cushion. So then if you have to liquidate a stock, you can liquidate those instead of looking or liquidating another stock you think is going to go up in the later time. So with that, are there any questions on the inverse stocks? So again, I'm just showing you the different products out there that are available. Just kind of widening your idea of how the market works, because there is a ton of stuff out there. It's not just, hey, I'm going to buy this stock and then that's it. Now, if you want to just set it and forget it, and for retirement, totally fine too. Low and slow, or not even low, or not even slow. Just you put in what you want, then you get a return, and then once you retire, hopefully that stock, that the company does really well. Um, but yeah, so there's that. Now you're thinking, oh, I'm not sure about these stocks. Is there anything else? Yes, there is. There's always something else. There's always, it's just like the Star Wars, there's always a bigger fish, but well, it's probably another thing. But you have the VIX. So VIX is volatility. Oh boy, I did not spell that right. Oh, with an I, duh. Um, so VIX means volatility. Now, these are 3 stock tickers that you can look at. And when I say stock tickers, these are just tickers. These are what are called ETNs. So ETF is exchange traded funds. ETNs are exchange traded notes. So the difference between a fund and a note is that, and I'll write it out. I'm going to actually type it out because it's a little bit longer. So the difference is ETNs equal, think of it like loans or a bond. ETFs equal the ticker, so like SPY, owns the asset, so the company. So what do I mean by ETNs? This again is more of a short-term play, but again, this is just if the market's down, you want to capitalize on some stuff, you want to hedge, things like that. These are tickers that are ETNs, and they follow the volatility. Well, what's volatility? Generally, and I mean generally, not all the time, but generally 98% of the time, if the market's going down, what do you think is going to happen? People are going to panic sell. There's going to be more volatility. When things are going up, volatility can increase too, based on what's going on. But more often than not, if the market's going down, then you can buy these 3 ticker or one of these tickers, and I'll let you do the research on that because we talked about due diligence. You need to look at it. Again, I'm not going to give you financial advice. I'm not going to recommend one of these things, but these again are just strategies on what you can do to protect your assets, to hedge, or to make a couple extra bucks on the side. Maybe go out to get some pizza or buy some flowers for your girlfriend or guy friend or whomever. So these are just 3 of them to look at. They're different companies. I think one's ProShare, one's Fidelity, and this one's another one. I'd have to look into that. But again, these you want to hold less than you want to hold it for like a day, if that. Again, I'm just exposing you to things that you can look at, things that you can trade. You can buy an option on. I don't think you can actually buy an option on these. I'm sorry. No, you cannot. I forgot. ETNs, you cannot do options. Let me double check. I'm pretty sure you can't. I think I. Oh, you can buy options. I'm sorry, guys. So, you can buy options on VXX. So this is the short term. Why would you want to hold it per day? Okay, so with ETNs, they don't hold the assets, so there's no interest. There's no interest on the stock going upwards or dividends or things like that. The way that notes work are it's similar to bonds. It's just you don't get the interest. That's the big thing. And there's also fees involved with shorting. So I was saying before, there's interest rates on shorting the stuff. So when you deal with these stock tickers or these ETN tickers, they have to pay all that stuff. So it's generally not a good idea because they hold a lot of different assets that are being shorted. So they have to pay a lot of interest with that. But again, when you buy into it at that certain time at that fund, that's when you can profit on that. So another strategy could be if you really don't want to hold it, you could just buy an option, and then if it still goes down, then obviously if everything's going down, then yes, you're going to make money. But the way that the market is right now in the last year, like one day it's like, oh my gosh, I'm so sad, with this, like stocks are so sad. Then the next day they're like, I'm so happy. So it gets complex. That's just kind of a strategy I would look at. Um, I mean, you can hold this. If it keeps going down, 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 yeah, it's just you're not paying interest. It's just the stock is paying interest for holding the shorts for that time. Um, so that's kind of why it gets a little bit more complex, because if you understood what these tickers actually do, like they'll trade futures, they'll short, they'll cover it, they'll go long for a second, then go back down, things like that. It's just these three tickers, they're meant, and also the ones that I showed before, these guys are meant, these right here are meant to be in a bear market. So I guess I should have said bear market in the beginning. But these could be good to buy in a bull market because you don't know when it's going to change. But then again, if you kind of read the room, and by the room I mean the market, things are going up. There was a scare, but again, we're in the middle of the week. What did we do with NASDAQ today? How are we today? Or let's do ES. Okay, so SPY was going up a little bit. It looks like it tried to break out, but it couldn't. So like a good example could be, well, a good example would have been, last week when we talked about the correction, maybe buy one of these VIX stocks or the SQQQ, or what was the other one? Or PSQ or SH. So if you see how SPY is, so this is a 15-minute chart, but I'm just going to give you an idea. I'll go to the 1 day and just zoom in right here. If you look at this, but then if I type in SH, it's going to look exactly opposite. Oops. Well, it's kind of weird. I didn't zoom in correctly. But if you were to look at the charts, if you see right here, it's down, down, down. But then if I look at SPY, up, up, up. So see how it went down. Now, it's not correlated to the price. It's different. They're different prices. So obviously, what was it again? SH is $33. So do you want to put like more money into it? That's up to you. But yeah, so, but yeah, so that's kind of the strategies again on what you can do. So again, this isn't saying to always do this. You just have to do a lot of stuff. This is more of an intermediate strategies, not dealing with options. I talked briefly about puts, but it seemed like a lot of people either knew it or didn't need to get involved yet with those. So I don't want to really cover those as much. But yeah, so we're done for today. I know it was a little bit shorter. I'm trying to shorten them down so then more people can listen to them, because before they were a lot longer. But yeah, so with that.